Financial markets haven't been spared by the COVID-19 crisis. At their worst point in March, global stocks dropped by about 30% before recovering slightly in the last month. And as we film this, things have gotten slightly better in the financial markets, but they're still down about 15% for the year. So even with recent rallies, it hasn't really been a good time for investors. When we examine how financial markets have performed, we start to see a kind of mirror image. On the one hand, stock markets around the world have suffered significantly, as the red bars pointing downwards show. We see a degree of variation here, with European and South American markets performing badly, while some Asian markets like China have sold off less. There are many reasons for this, but first and foremost, the main one probably is because Asian economies appear to be emerging first from the worst effects of the pandemic. On the other hand, the upward pointing green bars represent the so-called safe haven bonds issued by national governments, which are considered safe and financially stable. As you can see, 10-year US government bonds have performed very, very well, returning about 15% year to date. So why does this mirror image occur? Because in the midst of the crisis, investors have grouped different types of investments into two categories, safe and risky. And in the safe camp, you have the bonds that we just discussed, issued by credit-worthy governments, and of course gold, which has also done well. In the risky camp, you have the stock market, as well as other types of bonds that carry more risk than their high-quality counterparts. These include high-yield bonds, also known as junk bonds. When sentiment is bad, the risky group sells off and the safe assets show their resilience. When sentiment improves, as it has done more recently, then the risky group rallies. This is what we call the risk-on, risk-off effect, which we think will persist in the next few months as market uncertainty continues. So how should investors be positioning themselves? We're advocating two simple strategies. The first is stay invested. Don't panic sell when things get tough. Selling when markets are volatile could mean missing out on a subsequent rebound. And that's something we've already seen over the past few weeks. Now, research has shown that missing out on the rallies that happen immediately after a sell-off can damage investment outcomes. Also, because cash rates are so low at the moment due to repeated interest rate cuts, inflation is continuously driving down the purchasing power of your cash holdings. The second strategy is to diversify. Spreading your investment allocation across both safe and risky assets can provide a smoother ride when times get tough. In this case, we prefer the prospective returns of the stock market, i.e. the risky category, to the low yields currently on offer from government bonds, basically the safe category. Right now, for example, most developed market government bonds are offering yields of just 1% or sometimes even less. Within a diversified portfolio, we particularly like Asian equities because of their longer-term structural growth prospects. In addition, we feel that Asian economies have more ammunition to support themselves through the crisis than some developed markets. Economies like Europe and Japan, for example, already had record low interest rates going into the crisis, and the jury remains out as to whether further monetary policy will have much impact. But I stress, this is the longer-term view. In the immediate months to come, we expect the outlook to remain uncertain. And that is why we are stressing the importance of maintaining an appropriate level of diversification between both safe and risky assets. If you're in doubt, consider investing in a multi-asset portfolio where professionals manage the risk for you on a day-to-day basis. So, here are those main points again. Financial markets have not been spared by the COVID-19 crisis, and global stocks are down 15% for the year. We are currently in a risk-on, risk-off environment where risky and safe assets perform well or badly as sentiment rises or falls. And by keeping calm and staying invested during these volatile times, you'll have a better chance of achieving your investment goals. Selling at the bottom means crystallizing any losses and possibly missing out on a market rally when the sell-off ends. Lastly, but perhaps most importantly, amidst all of this uncertainty, diversifying your asset allocation with a mix of safe and risky investments will mean that you have a smoother ride and possibly less sleepless nights, while allowing you to achieve your investment goals. We wish you a successful investment journey ahead.